Good morning, everyone. Thanks for having me. I'm going to be a little bit different. Not sure necessarily more positive than what we just heard. We are in some economic strife here at the moment. But I'm going to go over and talk about interest, specifically interest rates over really what we're seeing now. And I did want to put this up here. These are the interest rates all the way from 1871 on the 10-year Treasury, the yields, just to kind of give you an idea of where we're at. We're obviously here at the end. Everyone thinks, interest rates are very high right at the moment because we're used to having them at zero. But relative to the long-term history, we're really about normal. In fact, we're still a tad below normal. And we've averaged basically 5% really for the last 100 years. And obviously you can see the last time, though, we had a high inflation rate, what happened to interest rates up over 15%. And hopefully we're not angling up there again, just to give you an idea of where we've gone in the last 50 years or so. Why are interest rates important? I think Warren Buffett puts it as well as anybody I can think of. He said, at all times, in all markets, in all parts of the world, the tiniest change in interest rates changes the value of every financial asset. And we are seeing that right now. And so I've kind of retitled my presentation to How It Affects Everything Everywhere All at Once. Don't know where that's from. Obviously, I think they won the Academy Award or something. My wife knows that information. I don't, but I do know about the movie. So, I always like to start with something interesting and questions to the audience. So, I'm an investor, try to make my students to invest and realize that the longer period of time you have, the better off you're going to be. The more you can invest, the better off you can be. So, I like to take them back to show how powerful returns can be, and especially compound interest. Let's say you were a Roman soldier hanging out outside the pub and were thinking about going down to the local bank or going into the pub. And you had your denarii, that being the currency at the time, and you could have either gone into the pub or you could have gone down to the bank where you could invest at 3%. Now, it's 2023 or 2023 years later. How much do you think that would be worth? A few million. In simple interest, it's obviously 3 cents a year. That is be about 600 cents or $60. But there's a lot of compound interest. No matter what everyone guessed in here, I would be willing to bet $100 you bet too little. Why? Because the answer is $97. Now, how much is that? That's 11 quadrillion for every person on the planet. Right? A lot of money. Time is very, very helpful for investing. Obviously, we don't live through 2023 years, and we're not going to end up with so much money. Where you put your money also is very important. Why? Because if you happen to go to the other bank, to the other corner, that was only paying 1%, you only ended up with 552 million, which is only around 8 cents per person on the planet. But this just gives you kind of an idea of the power of interest and what it can do for you. This led Einstein, of course, to quit. He who understands it earns it, he who doesn't pays it. And this is my famous picture of a place in Kentucky when I was running a race. And I saw that and I said, I got to take a picture of that because it says, borrow 200, pay back 203. Boy, that sounds really cheap, but if you have to do that in a week, not so much in terms of compound interest. I think in defense of the place, it was over a month. But you might laugh at that. If you're holding a credit card balance, you're the person that went into that building. So interest rates affect everything, everywhere, all at once. Well, they affect your 401k. This is actually a picture of all 500 stocks. Top ones being, of course, Apple, Microsoft, Google. Apple and Microsoft, those two stocks actually make up 15% of the entire market cap. Just two. The other 498 make up the next 85%. They actually take the 5 largest, that makes up about 20% of the market. The next 495 stocks make up the rest of the 80% or so. And if you look at the next 3,000 stocks, they only add about 10 to 15% of the market cap. So most of the economy is moved by these. And what are all those numbers? Those aren't prices. Those are something we call P's or PEs in finance, and it has nothing to do with the toilet I have up there. They're actually the price-earnings ratio. It's how much you're willing to pay for $1 of earnings. And we saw Apple around 20, Microsoft around 20. You can think of that as for every dollar Apple and Microsoft earns, you're willing to pay $20 a share for that. So if Apple makes $5 a share, you'd be willing to pay $100 a share for that. If you invert that, rather than going P over E, we go E over P, which we call the earnings yield. That is very related to the interest rates, which makes perfect sense. If the interest rates go up, so should my earnings yield. So if I can make 3 or 4% in my bank, I need to be able to at least make that in the market, so to speak. So if you think of the earnings yield for Apple, $1 over $20 of earnings, that's a 5% yield. And so if interest rates are 0, that sounds pretty good. Right? I'm making 5% in the market, I can make 0 with my banking account, I'm going to invest in the market instead. And the higher, of course, the interest rates go, which is what we're seeing now, the higher the yields need to be. And the higher the yields need to be, the lower the PEs will be, if you followed all that. In 2008, due to the financial crisis, late 2008, around 2000, like November, December, the Fed started lowering interest rates, and they've lowered them all the way to 0. What is this graph here? Well, these are the interest rates, believe it or not, just a year and a half ago, in August 2021. And everything you see in red, those are negative interest rates. We're not on there. But even countries like Greece, if you don't remember what happened there 10 years ago, they were going to bring down all of Europe because they couldn't afford to pay off any of their debt. We're all negative. Switzerland, being one of the, of course we know what happened to them this week, and if you don't, I'll tell you here shortly. Switzerland's got really negative rates. In fact, in Switzerland, there's even mortgages that had negative rates. So what does that mean? You could literally borrow $301,000 and pay back Swiss banks $300,000. What does this mean to you as a lender if you're buying treasuries from these different countries? Meaning literally you give the government $1,010 and 10 to 15 years later they give you $1,000 back. I'm not going to get into why they are possibly negative. To me, it still kind of boggles my mind. But people are willing to do that. If you have lots of money, the alternative, of course, is to put millions of dollars underneath your mattress. Probably not a good idea. Millions of dollars in the bank, if it's anything like Silicon Valley Bank, probably not a good idea either. So they're willing to take negative rates here. So Tina arrived. Now who's Tina? Girl next door? No. There is no alternative. Which is what we keep saying in the stock market, at least up until 2022, right? That there's no place else to put your money. Where else do you put it? Treasuries are paying 1-2% at best, even on the long-term scale of that. Short-term, basically through 5 years, you get 0. In a lot of countries, it was negative. So you put it in the stock market. What did that do? Well, when you run interest rates to 0, what happens to the PE ratios? Well, now I don't need to make an earnings yield of 5% with a PE of 20, I can do an earnings yield of 4% with a PE of 25. 4 is still greater than 0. And so the PE shot all the way up to 27 as you go all the way through December 21, basically here. The market, and that is 1,000 if you can't see that there on the left, close to 5,000, 4,700 there on the end, increased its value by 4.7 times, or 470%. Anyone who lost money in the market, definitely fire your broker in the last 10 years. It's almost impossible to do so. 20 to 30-year treasury bonds, and we're going to get to that here in a moment too, also went way up. And the best way I can explain it without doing all the math sort of thing is if you had bought a 25, 30-year treasury, let's just go with a 20-year treasury to make this simple, and it was earning 4%, and suddenly now it's only earning 3%, you've got a bond that's paying basically 4, other bonds are paying 3. Well, you got that for 20 years. Well, 20 times 1%, that makes that 20% more valuable. And so your bond will actually increase in value by 20%. If interest rates go down 2%, it will go up 40%. We'll see how that reversed here and how that has caused problems with certainly Silicon Valley Bank. Well, everything's going along just fine until the consumer price index starts shooting up. This is what happens when you print out lots of money and keep interest rates at 0 for long periods of time. Hopefully we won't have little bills like we have over on the right, which you can buy on eBay for roughly $2 to $3. That is a $100 trillion bill from Zimbabwe. $15% in the last 2 years. So if you haven't had a 15% raise in the last 2 years, you're worse off. I don't mean to be bearer of bad news. It took 10 years for it to go up 15% before that. Since 2010, if you're not making 40% more, you are actually worse off based on real purchasing power. So 39%. Everything was going along just fine up until really the last 2 years. So Tina left, Tara arrived. Who's Tara? There are reasonable alternatives. We like to make lots of names. She crashed the party. So the Federal Reserve, here is this green line, of course, was the yield curve January 2021. 0.0000000 for all intents and purposes, really out to almost 5 years. You got a whopping 1%. In fact, at one time, the 10-year Treasury was only offering 0.7%. Lowest it's ever been in the history of Treasuries. And even if you went all the way out to 30 years, you got a whopping 1.6%. So to control inflation, keep everyone from spending money, hopefully, rather than spending all your money, you start saving your money, the Fed started raising interest rates. And by the next year, yield curve started pushed up, then they pushed it up again, and then pushed it up again, to where, and this has been changing a lot the last couple of weeks for good reasons, we have actually a downward sloping yield curve where you can actually make 5% in short-term treasuries. It's downward sloping, meaning long-term treasuries at 10 to 30, we're only making 4%. Now, don't know if you know much about downward sloping yield curves. It generally is a signal of recession. Now, don't worry too much because I think they actually predicted 10 of the last 7 recessions, meaning they keep predicting recessions that don't actually come. But we've never had a recession where this hasn't occurred. Sometimes they just predict recessions that don't actually show up. I suspect this time it probably is predicting a recession, not necessarily good for lots of different things. When we got back that PE part, well, that takes the E down. We don't like that either. But terror crashes the party, and what happens? Well, your retirement savings doesn't like that, right? If interest rates are going up, the yields are now 5%. I'm not going to take a 5% yield on my Apple stock. Now I want 6 or 7%. Which you invert that means the PE starts dropping. It's gone from the 27, now they are down to the 20 level, and I suspect it to drop even a bit more. There's other ways to kind of calculate all this. I didn't have anyone to stop me from putting equations on here, so I did put one on here. The last presentation I did, I had an older fellow, we were talking to a kind of a financial planning group. He scratched all my equations off of there, but I was able to keep this one on here. One of the things about trying to predict what the stock returns are, and that's why they're so exciting, we have to predict earnings from now to infinity and discount them back from now to infinity. We have no idea what E is going to be. I have no idea what I'm going to be able to sell it for in the future. It's all unknown. It makes it very, very exciting. But it simplifies if you assume kind of these constant growth rates and a constant cost of capital. This, the price equal E1 divided by K minus G. K being what sort of return do you want on your stocks. Now, even when you assume growth constant and K goes up, well, that value comes down. And if you divide both sides, of course, by E, you have the PE equal 1 over K minus G. And for every 1% you increase the K there, depending on what your G is, you can figure out the PE ratio will fall 2 to 3 points. So if it goes from 25 to 22, just to give you an idea what that would do to the S&P earns around, in total with the 500 stocks, you sum up all their earnings, it's around $200 a share. And so if the PE falls by 3, that means the S&P is going to fall by 600. It's only around 4,000 now. So it could easily go from 4,000 to 3,400. That's another close to 15 to 20% drop. It also affects bonds. All right. So now I have this 2% bond, and now yields are 4%. Right now I'm making 2% less. Rather than getting $20 every year on a $1,000 investment, other bonds are getting 40. That makes mine, 2% worse each year? Times 20 years is a 40% drop in bond prices. That's more or less what we've seen. Silicon Valley and Signature Bank didn't like that, especially Silicon Valley. Where did Silicon Valley have most of their money? In 20 to 30-year treasuries, about 90 billion of it. Well, they lost about 30 to 40% of that value. Now, I won't get into all of how they do their accounting, which is weird accounting. But some of their bonds, they actually can value at maturity. They don't have to actually value what they have to sell it for. It's called valuing at maturity, not to get too many details. Unfortunately, they weren't able to hold all those bonds to maturity. They had to liquidate quite a few of those to pay off everyone that was pulling money out of their banks. All that caused a huge panic, of course, if you've been paying attention to the news at all. The yield curve has come down more than it ever has in its history, at least on the short end, over 1%. And so that's kind of caused a ruckus. Signature Bank over in New York, everyone was looking at that saying, I got all these deposits worth more than $250,000. They're not insured, so they started taking money out. And it's also caused, when we talked about interest rates affect everything everywhere all at once, then people started looking at Credit Suisse as well. Said, I don't like their assets either. And so a lot of money started getting pulled out of Credit Suisse, which also caused them just the other day basically be taken over by USB. There is no Credit Suisse anymore. Home buyers don't like this either. More home sellers for that matter. Why? Well, 30-year mortgages have gone from under 3 just a year and a half ago to over 6. Like the last I saw was 6.75. The whole Silicon Valley Bank issue caused it to go to 6.5. But that means on a $300,000 mortgage, if you had a $300,000 mortgage, you were paying $1,200. To get one now is going to cost you $1,800 plus, depending on how much over 6% you have to get. Alternatively, you got X amount of money to buy a new home, say $1,500 a month, could have bought you a $355,000 house before all this began. Now it can only buy you a $250,000 house. And if you're selling a $355,000 house, most of your market just disappeared, which is why basically the housing market has come to a standstill. And just last month, we've had our first decline in like 5 to 10 years in housing prices. I don't expect that to stop anytime soon. Nobody likes this. This is, of course, the U.S. debt clock. I probably need to update this every second because it really shoots up. Please go to this and kind of watch it go up. It'll kind of frighten you. But right now, we're roughly at $31 trillion. Now, is that bad? Well, $6 trillion of this is actually held by our Federal Reserve, which is insane. They used to hold basically none. Now they hold $6 trillion. So one of the ways to get rid of $6 trillion of this is the Treasury, of course, doesn't print currency. That's the Federal Reserve. But they do mint, I should say, coins. And there's been a lot of discussion of them minting $1 trillion coins and giving 6 of those to the Federal Reserve. And voila, you no longer have a $31 trillion debt. You have a $25 trillion debt. Still bad, but it's a little bit better. But that really gets to the point you're really just printing out money and spending it, which is not good either. The other worry that I have, kind of falling back on John's, let's just make this really pessimistic today. U.S. tax receipts are $3.2 trillion. That's not including Social Security and Medicaid. 44% of U.S. debt has an average maturity of 3.4 years. 44% of that debt is basically paying 0 interest. I mean, it's not costing us anything. But what's going to happen as 16 trillion probably by the time a couple of years goes by, that they have to refinance that. They're not going to refinance it at 0. In fact, just the other day, it was 5, now it's down to 4.3, which, believe it or not, that saves a lot when you're talking trillions of dollars. But the interest on the debt looks like this. We are going from basically the $400 billion range, which is less than 10% of the entire tax receipts, to $800 billion currently, and is expected to go to $1.5 trillion in the next couple of years. Well, $1.5 trillion is about half of everything we collect in tax receipts. Am I worried? A little bit. When am I super worried? When the amount of interest exceeds the entire U.S. tax receipts. Then you're definitely in default. There's no way you can pull that off. Your debt will increase without limit. The only people, and I put a star there, it says nobody likes this. I put a star there. I want to write this down. I think the only one that doesn't really care, likes it or dislikes it, is Congress, because they don't seem to be concerned about this whatsoever. So that's my little asterisk up there. That's for them. On the other hand, so we always like to, as economists always like to say that, stocks are on sale, bonds pay interest again, and since I have just 2 seconds for questions, I will answer the 2 questions I may or may not get. One is, what do I think is going to happen a year from now? For interest rates, 67% of the time, the interest will be within plus or minus 1% of where it is today. And that's really what I expect by the end of December. And the other big question I get is, where are stock prices going? Because everyone likes, as soon as people find out from a finance professor, they think, what do you think the stock market's going to do? And I sit back and said, So you got 3 or 4 degrees now at this point, a bunch of letters behind my name, 40-odd years of experience or so. I think deeply, and then I turn around and look at them. So I'm 95% certain that the market's going to be somewhere down 30% to up 40%. The end.